The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rebound rally confronts market malaise. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. on this Friday. And actually, we have some gains to talk about. Totally different photo from what we were looking at this time yesterday. The S&P 500 higher by about 0.4%. Big tech was your drag lower yesterday. It's your boost higher right now. The Nasdaq 100 higher by about 0.6%. Take a look at what's going on in the bond market, specifically with the 10-year Treasury yield, because we started the day lower. About 8 a.m., we got actually closer to 4.06% on the 10-year Treasury yield. You can see that we've totally reversed and then some. Now taking a look at yields about 3 basis points higher on the day, sitting at 414. So some really interesting swings going on there. And I also want to highlight Bitcoin, Romaine, because this is really interesting. We broke through 100,000 and we have just continued to fall. Bitcoin now under $96,000 a coin, down about 3% on this Friday.
Yeah, the price action today really intriguing. Think about yesterday, that market momentum factor, that strategy that focuses on buying recent gainers and shorting some of the laggards. Well, that was a big loser on Thursday as that crowded AI trade did get just a little less crowded. But the buy the dippers today trying to flip the script, and well, they're going to have to try just a little bit harder. You saw the price action on Katie's screen. Conviction behind the buying into the close, sparse to say the least. The question is why? And well, why not? What's really changed over the last 24 hours? Volatility spiked Thursday, still remains higher today. The S&P's trading range on a peak to trough basis this Friday, not only wider than yesterday, but the second widest since April. Then you look at the Fed rate cut uncertainty that underpinned the sell-off yesterday, and you see that fog far from dissipating. A 43-day government shutdown delaying at least 43 economic data reports, and as of right now, only 4 of those reports have been rescheduled so far.
People are jittery, people are nervous. Prices and valuations have moved very aggressively higher, particularly in the third and fourth quarter, which means that the markets are fragile to any bad news. And that fragility is what's being seen right now.
Yeah, and that fragility, a byproduct as well of positioning and flows now so skewed to the bullish upside, they've actually come out the back end as a headwind. And that's not just about the economic data and the Fed's next rate decision 3.5 weeks from now, but it's also about a meaningful test for the market rally in 5 days, Katie, when NVIDIA releases results.
Absolutely going to be extremely important, especially in an environment where we're still not getting that economic data. But I wanted to go back to what Romaine mentioned about yesterday's sell-off, that repricing of Fed expectations. Let's take a look at what the market is saying as to what we're actually going to get in 3.5 weeks' time, because right now you have just about 11 basis points of easing priced in. I don't need to tell you that that is far fewer than 25 basis points. And think about where we were just a month ago. We actually had 28 basis points priced in around mid-October. So more than one single 25 basis points cut had been expected. You can see that has been pretty much taken out, and Romaine could explain why you're seeing some of this nervousness come back into markets, that maybe this Fed isn't going to ease policy by quite as much as expected, at least for the remainder of 2025.
Let's kick things off with Tony Roth, Wilmington Trust Chief Investment Officer. And Tony, a lot of eyes right now on the economic data that should start to materialize over the next few days, how that feeds into the Fed's December 9th meeting, and the so-called third rail out there that you referred to, Tony, yes. The idea of a softening economy that maybe we just haven't come to terms with.
Yeah, I think that you guys hit on all the key themes in your intro here today, which is the markets are reacting to the Fed. The markets are in a pause relative to the incoming earnings data from the AI companies, with the big one hitting next week. So we had most of them last week, and then we've got this pause with the rest of them hitting next week, or NVIDIA. And so there's a bit of an opportunity for the markets to take a breather there. And then we have the dissipation of the data fog, Romaine, which you just referenced. And so when we look at the environment, we have seen a very persistent disinflation all year. So we're not worried that the onslaught of inflation data, if you will, when it starts to hit, is going to show a different picture. And we have, in fact, a lot of secondary information around the labor market. So, for example, we look at the ADP and we see significant drops in private payroll creation. We look at the Challenger series and we see significant increases in layoffs.
Yeah.
And so we also believe that the labor market continues to deteriorate. We don't necessarily believe that the unemployment rate is spiking yet.
Yeah.
Of course, we're not going to know that for a while because we're going to get for October.
Yeah.
We're going to get the enterprise, but not the household survey. So we'll see how many new jobs have been created, but not how many people are in the labor force.
Yeah.
But the key with all this is going to be to understand the real economy.
Yeah.
And when we look at the real economy, we see we haven't gotten third quarter GDP. That's also been blacked out.
Yeah.
But when we get third quarter GDP and fourth quarter GDP,
Yeah.
we think we're looking at economy growing around 1%. And that's probably weaker than the markets actually anticipate.
Just on that jobs front, we are getting some breaking news right now, Tony. The BLS now starting to update its schedule for updating us on those missed data releases. That September jobs report that was supposed to come out on October 3rd will now be released on November 20th. The BLS also updating some of its other dates for releasing that data. But to your point, though, Tony, you kind of talk about this idea. Some of the data we're going to get is going to be incomplete. So I am curious as to whether you anticipate we will have more clarity within the next 3.5 weeks before the next Fed meeting, any real clarity from official government data, or is it still going to be this muddiness, this fog, if you will?
No, I do think we're going to get a lot more clarity. I think that first of all, the numerator or the enterprise part of the labor information as opposed to the household information is more important. It tells us how many new private payrolls are created. So that's the numerator of the unemployment rate. So that'll come for the month of October. We will get a full, complete November, we believe, labor report in the beginning of December before the Fed meets. And then we'll get the inflation data certainly for all of the months that we've missed it prior to the time that the Fed meets. So all of that will come in, and I believe all of it will continue to show what we've seen all year, which is that persistent disinflation along with a very consistently weakening labor market. And then the question will be the third rail, which is how weak is the economy really? And so we'll have to see when the government provides the third quarter view on GDP to see how weak we were coming into the fourth quarter. Now, earnings have shown that the big companies in this country are holding up reasonably well. We don't think we're in a recession now. We don't think we've fallen that badly. But we'll have to see what that data shows.
Right. Well, to that point, Tony, you think about what we have just next week in terms of the corporate earnings slate. We have Walmart, for example. We also have BJ's Wholesale as well. So some interesting reads when it comes to the consumer. Home Depot, what are you going to be looking for there, especially because there's going to be questions about the quality of the data, the delayed releases that we're finally going to get?
Yeah, Katie, I think we're going to be really looking at the guides, frankly, because when we looked at, for example, the financials that have already reported, some of the B2C software companies that have reported, they've provided good guidance for consumer activity on a go-forward basis. And so same thing when we look at these companies that are in the retail space, it's going to be the guides that we're going to be looking at very much. The other thing I'll mention is that I do think that the administration may have gotten the memo on pricing pressures that consumers are feeling, because we're seeing a lot of different areas now where the four Central American countries with regard to food, the news today was Switzerland, there's rumblings around maybe actually making some progress with Mexico and Canada, so that goods beyond the existing trade agreement exclusions start to get some better rates, et cetera. And so we could be in an environment where we actually get some relief now relative to baseline from the tariff standpoint. That'll help us too going forward. So there's a lot in the mix here for sure.
All right, Tony, I have to leave it there. Always great to catch up with you. Tony Roth, Wilmington Trust Chief Investment Officer, kicking us off to the close here on this Friday afternoon. A close eye on what's going on in the crypto sector. Big changes there from a legislative standpoint, and we're going to talk to a woman who's helping some of those companies get through it. From dollars to digital assets, BNY launching a new money market fund for stablecoin issuers. Stephanie Pierce, Deputy Head of BNY Investments, coming up in a bit.
Plus, the shutdown showdown may be over, but its impact continues to linger. The former director of the National Economic Council, Gene Sperling, will share his economic outlook.
And it's electric. The CEO of Commonwealth Edison in the fourth largest data center market out there in Illinois. He's going to join us to talk about how his utility company is trying to meet the rising demand for power. All that and more coming up in a bit. This is The Close on Bloomberg.
Well, recent Bloomberg intelligence analysis estimates that stablecoins could account for more than $50 trillion in annual payment flow by 2030. And BNY Mellon is positioning itself to be next up to bat. the firm launching a money market fund for stablecoin issuers, another peg in the digital asset growth story that stems from the passing of the Genius Act earlier this year. Joining us live in studio right now, I'm pleased to say, is Stephanie Pierce. She is Deputy Head of BNY Investments. Great to see you, Stephanie. So let's start with just what this is, a money market fund for stablecoin issuers. What exactly does that mean?
Sure. So as you said, the Genius Act was a landmark legislation that really removed a key barrier to the growth of stablecoins and issuance in the U.S., which was really creating that regulatory framework that everyone's been needing and wanting to understand how to structure these. And with the passage of the Genius Act, what we've launched with the BNY Dreyfus Stablecoin Reserves Fund, which was actually went live yesterday, is essentially a way for stablecoin issuers to access the same liquidity, resiliency, and stability of our money funds, and also comply with the reserve requirements in the Genius Act. And while it hasn't gone, the Genius Act will take a little while to go into effect, we do expect that we'll see migration sooner than later. And just to be specific, the difference between this money fund and the traditional money fund is that the maturity of the securities, the U.S. Treasury repo and Treasury securities, must be 93 days or less, which is a little bit shorter than a traditional money fund.
It's really interesting. And you think about the stablecoin environment, and I think a lot of people at this point know about Tether, they know about Circle, but you think about the variety of stablecoin issuers out there. Theoretically, this money market fund is for any number of them?
Yes, and we do believe there will be many more of them. In fact, BNY just published I'll call it a primer or an outlook on the digital asset industry and what we think will happen. And in that, we talk a little bit about this space, not just tokenized money funds, but the sort of what we call programmable money complex, right? So tokenized money funds, stable coins, tokenized deposits. And our projection is that we could see that entire sort of set of programmable money and cash equivalents grow to as much as 3.6 trillion in 5 years. That's 2030.
And you have a sense here that the people that are coming into this, they're going to be comfortable with the return on that cash. They're not going to be seeking something a little bit greater, something maybe with a little bit more leverage. They're fine.
Well, again, there's requirements that if you think about what the Genius Act actually says, it's pretty prescriptive in terms of the reserve requirement that a stablecoin issuer has to use.
Okay.
So if you think about it, right, they have the choice of either investing in these types of securities themselves,
right,
or actually using a money fund. And so if you think of what the core business of a stablecoin issuer is,
right,
it's probably not to invest in the securities themselves, so they'd much rather use a proven and trusted
Are you surprised by this? I mean, I think about, you think about what the crypto industry is, and then you think about BNY, which is kind of like the oldest of the oldest banks out there, and it's safe. I mean, I don't mean this disparaging, but you guys are like kind of like the vanilla ice cream of the financial markets. And meanwhile, crypto is like, I don't know, what we want to call that. And so the kind of the melding of these worlds, and you see that deepening, that relationship deepening between the two?
I would say it a little bit differently, right? So cash and liquidity are the lifeblood of a custody bank. It's what runs through the arteries and veins of our ecosystem at BNY. And I'm sure you've heard us talk about the 20% of global capital market assets that traffic through BNY's infrastructure every single day. So what we're doing as BNY is trying to bridge the traditional infrastructure that the whole financial industry traffics on to the digital infrastructure. And cash is the cornerstone of the digital ecosystem that allows you to move from one to the other. So as you think about a world where we're moving from traditional, where there's market hours and there's all these frictions in the market, right, to move toward a 24/7 environment, we won't get there tomorrow. You're going to have to bridge from one to the other. And cash, which is the lifeblood of our bank, is what gets us there. I will say, since I've promised Katie I would give her a better term.
Lay it on me.
Go ahead. I like to think of both structurally and cyclically. Cash is kind of where the cool kids are hanging out these days, right?
Yeah.
Katie teases me about saying cash is sexy.
I found it. You said that in July of 2022, which is pretty amazing because you think about money market funds, where we were then, there was about $4.6 trillion in money market funds, July 2022. That felt like a lot. Then you think about where we are right now, 7.5 trillion. I mean, how do you explain just this insatiable and building demand for money market funds?
So there's a couple things, right? From a cyclical perspective, cash is pretty attractive right now, right? In a money market fund, you're getting almost a 4% yield, notwithstanding what the Fed may or may not do in December. And relative to both the volatility and predictability and sort of safety and soundness of other asset classes, it looks still pretty attractive. What's probably even more interesting when you think about it is if you think about the Fed's neutral rate, we could debate, it's at 2.5%, is it 3%, right? What that tells you though, if that's where that rate is, that this allocation that you see in money funds in a given portfolio is probably here to stay for a while. I would say though that what's really most exciting about it is cash is really at the vortex of all of this change. It's facilitating and enabling the rails of today to become the rails of tomorrow and to be able to go back and forth. And that's really where BNY, as you said, is the oldest bank in this country, the first ever listed on the New York Stock Exchange. We're really proud to be kind of leading the way for our clients.
And apparently full of all the cool kids as well, too. Stephanie, great to have you. Stephanie Pierce is deputy head of BNY Investments. All right, when we come back, we're going to talk about the earnings season. More than $50 trillion worth of stocks in the S&P 500 have reported earnings. Other than the biggest one in there, NVIDIA. They're scheduled to report in just about 5 days. We're going to catch up with Joseph Moore at Morgan Stanley and get his thoughts on some of the estimates and whether they actually might be still conservative. That's coming up next here on The Close. This is Bloomberg. Let's get right to our top calls. The big movers on the back of analyst recommendations. And we start off today with Home Depot. Stifel downgrading to hold from buy. The price target to $370 from $440. The analysts calling the home improvement category stagnant at best, with risk of deterioration into the holiday season. Those shares now at their lowest level since July. Next up, Gap. Jefferies upgrading the stock to buy with a fresh $30 price target. Analysts citing encouraging and sustainable trends and tipping their hats to CEO Richard Dickinson's structural revamp since he took the helm in 2023. Those shares nevertheless down fractionally on the day, 2 straight days of declines. Remember, they report earnings next week. And finally, Microsoft. Baird breaking into the bullish camp, initiating coverage with an outperform and a $600 target. The analyst calling Microsoft a core long-term AI holding and expects further double-digit revenue growth. Those shares up about 1% on the day, and those are some of our top calls. Another tech behemoth that we're watching closely is NVIDIA. Those shares closing out a tough week on a positive note ahead of the chip maker's earnings report next Wednesday. Our next guest has an outperform on the stock and says even his estimates may be too conservative. Joseph Moore joins us right now, managing director at Morgan Stanley. And it's kind of hard to look at expectations around NVIDIA, Joseph, and think that they're conservative, but kind of explain that. I mean, you think that maybe we're under sort of maybe anticipating what this company can deliver?
Yeah, well, we've seen remarkable strength in AI infrastructure spending. And I do think that even with sort of high expectations, they guided for $7 billion of sequential growth, which is bigger than all but 3 companies in our coverage. And that's incremental revenue in 1 quarter. We have them doing $8 billion of sequential growth again in January. But if you go back to their comments from the technology conference in Washington, D.C. a couple of weeks ago, they talked about a $500 billion 2-year spend on Blackwell Rubin. That would point to upside to even the new estimates that we put out this morning. So how quickly you can deploy that, there are various bottlenecks, as we've seen. That's part of what's held back the stock. But I think it should be a very strong earnings report with upward revisions to numbers coming from that. And yeah, I do think that the numbers as they lay out for 2026 are quite conservative.
Is there any sense here that when we start to talk about refresh cycles, there's been just some discussion that new entrants into this space are actually looking at chips other than Blackwell, the idea that you can maybe do some of the inferences and other AI tasks without necessarily having to spend on Blackwell?
Yeah, so NVIDIA from a revenue share standpoint is about 85%, right? And the alternatives are custom silicon from Broadcom, AMD as a merchant competitor, and there are others. There is a lot of effort to make sure that there are alternatives to NVIDIA. NVIDIA chips are expensive and allocation is difficult. Everybody's vying for more compute as we sort of look at this. And there are different workloads, as you said. Inference is going to have different requirements than training has had. But we feel like NVIDIA is still in a very strong position from a market share standpoint. A lot of these technologies seem compelling, but as you deploy it, you start to feel like, okay, but my highest ROI is on the thing I've been using all along. And we're actually seeing these workloads evolve such that, workloads like inference that we thought needed to be inexpensive are really requiring quite a bit of compute as well. As you start doing these, reasoning models and the tokens are exploding in length, there's a lot of demand on the inference side that seems to be gravitating to even NVIDIA had lower end inference chips, lower price chips. A lot of that demand is moving to the high end. So, that 85%, I think they'll remain in that rough range. We certainly have enthusiasm for some of the competing solutions as well, because it's just a great market right now. But I think NVIDIA, while the stock has done fine, has underperformed some of the direct peers. Right. And I think this quarter is one where they can really remind people that, hey, most of the spending is still coming towards us.
Well, it's going to be fascinating to see the reception, because it feels like if you take a look over the past several quarters that it's turned into a bit of a sell the news event, Joseph. But I do want to talk a little bit about China, because you mentioned potential alternatives, and there's an existential fear out there that China is going to develop chips homegrown that can compete with NVIDIA's offerings. And you heard from Jensen Huang actually earlier this month telling the FT that China is going to win the AI race. And I wonder, where you fall on that question.
Yeah, I think what he's saying is that there is a lot of software expertise in the AI space in China, and that if you don't allow NVIDIA to sell at least some solutions into that market, that it can be something that can spur the development of the domestic ecosystem in China. I think all that's fair. It's what we should do from a policy perspective is above my pay grade, but there is a trade-off there of, do we slow down their software effort by enabling a software ecosystem? But the U.S. companies are in a very strong position, have developed very strong models, and I think that the Chinese companies actually would very much like to use some form of NVIDIA silicon. And right now there's nothing in the model coming from China, and I'm not anticipating that that'll change anytime soon, because you have two governments that are sort of blocking those sales. But I think there's a lot of opportunity if you can make that work. And I do think, we have regular meetings with some of the Chinese hyperscalers. They do want this technology, even if they can't get the latest and greatest. They do want technology, and I think that's all that can drive upside for NVIDIA.
All right, Joseph, great to get some time with you. Have a great weekend when you get there. That is Joseph Moore, Managing Director over at Morgan Stanley. Now, coming up, the shutdown may be over, but data delays and questions around reliability loom large. Gene Sperling, the president of Sperling Economic Strategies and former national economic advisor to President Clinton and President Obama, joins us next. This is The Close.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, just a few hours away from the weekend. I don't know, it's hard to focus, but there is a lot to focus on, especially when you think about the headlines that we're getting about this slow trickle of when we're finally going to get these data releases.
I went and actually counted how many data releases we missed.
Yeah.
It was 43, and that was just the ones I could find. I'm sure I probably missed a couple.
Wild.
So we're going to start to get a trickle of that. They've only confirmed so far 3 or 4 reports that are going to be updated, including the September jobs report, which is supposed to release October 3rd. That will release November 20th. The October jobs report, which I think we were supposed to get last Friday.
Right.
They have not updated us on when we'll get that. And there's an issue of whether the data is even going to be complete, that we're only going to get maybe some part of the survey, but not at all. So I'm so confused.
Unclear what the collection efforts actually looked like during the shutdown. So still a lot of questions, even as we get this trickle.
No one called me during the shutdown.
No,
so how do I know?
I don't pick up the phone, so I don't know. Well, that's the other question, right?
I know, check your phone.
We've been talking about the quality
from Romaine Bostick.
From Romaine Bostick. We've been talking about quality of data even before the shutdown. So let's keep the conversation going now, because the aftermath of the longest government shutdown in U.S. history is slowly beginning to play out. And here with his perspective is Gene Sperling. He is president of Sperling Economic Strategies, former senior advisor to President Biden, and former national economic advisor to President Clinton and to President Obama. Gene, fantastic to have you with us. So we've been talking about this fog that we're in when it comes to the economic data, the fact that we're not getting it. Now, as we start to get these very delayed releases, a lot of questions about quality, a lot of questions about reliability. And I wonder, in your view, is the fog going to clear at all?
Great question. And I don't totally know the answer. So, for example, I was national economic advisor during the last long shutdown in 2013. And at that time as well. The data did not come out on time, but it came out about as many days as the shutdown lasted. Now you have the situation on the jobs numbers where the person in my former job, Kevin Hassett, is suggesting that maybe we will get the payroll and establishment jobs, but maybe we will never get the household survey, which tells us what the unemployment rate is going to be. And I do think it's difficult looking at the private data, because if you look at ADP, they tell you that we probably gained 40-some thousand jobs in October. Not great, not horrible. But now they have a new weekly index that suggests by the end of October, we might have actually been losing 10,000 jobs. Now, you heard Chairman Powell say when you're in a fog, you drive slower. And so I think that's why people are not as confident about this cut in December. And then I think the other thing is that, I think the administration has hurt itself by kind of doing things that are essentially stagflationary. So immigration and the tariffs, they're harder than a lot of things for the Fed because they both have negative inflationary effects and they tend to hurt growth at the same time, which makes you have to weigh which is the worst. And again, I think that the tariffs are more likely to keep having inflationary pressures. I think the big retail stores are doing it more slowly, so we haven't had the big boom. But you still have an economy that was projected last January to be at 2% inflation, and it's at 3%, and you don't know what's going to happen with the Supreme Court, and you have a lot of reason to think that big stores are going to continue to gradually raise prices for maybe the next several months.
Right. Well, when it comes to inflation and just the lived experience of Americans, the case could be made that one of the reasons why the Democrats lost the presidential election was that they downplayed those cost of living pressures. And you could make the argument that that is what the Trump administration might also be doing here, falling into the same sort of trap. And Gene, I wonder from where you're sitting, what the White House could actually do at this point to alleviate some of those cost of living pressures, which are still very high.
Well, you're right. And I think for many of us in the Biden White House, we've been very surprised by how, not even how much they haven't seemed to care about connecting with people on inflation, but doing something like the kind of erratic tariff policy, which a stunning number of Americans know about, will report in the University of Michigan Consumer Confidence Survey and will say they're raising their prices. I mean, in fairness, Joe Biden had an economy where you had booming job growth, you had booming GDP, inflation was coming down, and even still, people were so upset that the price levels were so much higher than they remembered before the pandemic. Now you have an economy that's not doing that great. You have a job market that's not that great. This would be a time where you think you'd be very focused on connecting with people. And I think they're just stuck. The president is pushing certain policies that are somewhat inflationary. And, the best I've heard is Secretary Bessent say, hey, we'll pull back on coffee and bananas because we don't make them here. And that's kind of admitting that wasn't a very smart policy. And yes, it was raising prices.
Yeah, I mean, the bananas, coffee, and tomato thing, probably one of the most ridiculous walkbacks I've seen by this administration. But on a more serious note, it gets to this idea of those inflationary pressures, which have never really dissipated. To a certain extent, they've been exacerbated. And that kind of segues into this idea, Gene, of going into the next year with people not only focused on food costs, but also energy costs. We saw those prices go up significantly, primarily because of the AI data center build out. And we saw that become issues in at least 2 campaigns this year in Virginia and in New Jersey. How does either party address that, if at all?
Well, so that's interesting because that in some ways does connect more with the Biden White House experience. Because as I said, we had a lot of things to brag about with jobs and GDP, but people didn't care as much if the price levels are still higher than they remember. Now you have the administration, they have kind of one positive surprise that's happened in 2025, and that has been the GDP impact of AI. And yet, if they may be missing the fact that that is putting greater pressure on, as you say, electricity prices. And, then you combine that with health costs likely to go up. And then you combine that with, Moody's and Bank of America thinking some costs will go up because of inflation. I think it puts you in a difficult situation. I think if I were in the White House, I would not, learning from the Biden experience, you wouldn't be just bragging about the AI, the $1 billion, but you would let people know, hey, we want to lead in AI. We want to beat China. We want to do it in a way that's more humane, pro-jobs, but we also want to do it in a way that, you're not seeing people make hundreds of millions of dollars while your electricity costs are going up.
Well, that's what I'm curious, and I'm not really seeing that being articulated by either side. And as you know, as somebody who's been in the White House, most people, rank and file people, they don't know what GDP is. You can say, okay, you're contributing to GDP. They don't care. They don't care about those high-level numbers. They care about what they can see on a day-to-day basis. On a day-to-day basis, they're still struggling, Gene. Then they look at AI, or they at least look at the media coverage, and they see stories about job losses and all the negative effects of it. So we're basically in an election cycle now, Gene. So it gets to this idea as to then, if at all, how do you change that narrative so that it's more palatable to regular folks, not just, people on Wall Street?
Yeah, no, it's a great point, and they put themselves in a trap. And so I actually do think rolling back the tariffs, particularly on consumer goods, on things that will never be number one on or compete on, I really don't think there's a lot of, if Nike Air Jordans go up $40, I don't think people are going to go, great, they're, encouraging more production to shift back. They're just going to be angry. So, I think that we always knew that gas prices had a very negative effect on presidents and politicians. But it turns out it's not gas prices per se. It's what you just said. It's everyday prices that you see every day. And what happens is when your job market's great, that's helping some people. But when your prices are high, that's hitting everyone. So but I think the hard part is, the best thing the president can do is roll back the things he's done. That means admitting that wasn't a good idea. That means admitting that, yes, tariffs are a tax on consumers and raise prices. So they may face a little bit of a choice of how much do they want to connect with everyday people, and is that worth perhaps stepping back on some of the claims that most economists have never accepted about the idea that tariffs on ordinary goods were not going to hit people's pocketbooks.
All right, Gene, got to leave it there. Really appreciate you taking time. Gene Sperling there, president of Sperling Economic Strategies and former senior advisor to President Biden. When we come back, we're going to talk about Walmart and a changing of the guard. This is The Close on Bloomberg. All right, keep an eye on shares of Walmart today after investors got news that longtime CEO Doug McMillon is going to retire in February. Now, he's going to be replaced by another veteran, the head of the company's U.S. division, John Furner. He will take over for McMillon as a big box retailer now transitions from the e-commerce age to the AI age. Norah Mulinda joins us right now, Bloomberg Markets correspondent, talk a little bit about this. Look, McMillon's been there for over a decade. He's kind of lauded as one of the better CEOs that we've had of this era. So maybe his time was coming. Investors, though, I guess a little on the fence here about what to make of it.
Investors are still trying to figure out how they feel about this. But if you look at Wall Street, analysts are saying that this is good news. This is nothing to fret about. They do expect some near-term weakness here, but they ultimately don't see this as any sort of pullback. They see this as a good transfer of power here, and they do see that the bench here in terms of the executive space at Walmart is very strong. So they're not concerned at all.
It's interesting, McMillon, only 59 years old. Furner is 51 years old. Just a little bit of trivia there. So this is also interesting, this change of the guard, but also because they report earnings next week, Norah, and in just 30 seconds, I have to imagine that this will be a topic of conversation.
Most definitely, this will be a topic of conversation, but also on the mind of investors will be tariff concerns and how they do in terms of sales performance. Back to school season, we did see last quarter, so that's definitely going to be something that a lot of investors are parsing during this time.
All right, Norah, great reporting. That is Bloomberg's Norah Mulinda. She is our markets correspondent. And
now, are you a Walmart person?
You
live out in the hinterlands.
I know. Well, that's the thing. I love Walmart. Yeah. There was one near my parents' house, and I remember doing like college shopping there, but then it shut down, and now it is a marijuana grower. So.
All right. Coming up here on The Close.
We're going to take you to the closing bells with Veronica Willis. She is global investment strategist over at Wells Fargo Investment Institute. That conversation up next. This is The Close.
When we look at the environment, we have seen a very persistent disinflation all year. So we're not worried that the onslaught of inflation data, if you will, when it starts to hit, is going to show a different picture. And we have, in fact, a lot of secondary information around the labor market.
Tony Roth kicking us off to The Close just about 50 minutes ago, a conversation here about the reopening of the government and, more importantly, the redissemination of all that data that we missed.
Yeah, absolutely. Looking forward to getting those very delayed reports. Maybe there's going to be some numbers missing there. Let's take a look at what the equity market is doing with about 10 minutes until the closing bells. The S&P 500 giving up its gains. It is still very slightly positive on the week. I can't say the same for the NASDAQ 100. And if it finishes in the red for the week, Romaine, this will actually be the second straight week of losses for the big tech index, which feels a little bit surprising.
A little surprising, but when you consider how high valuations are, and then this, I think it's funny, we keep talking about the Fed overhang. I feel like there's this NVIDIA overhang too, right? Like, I think expectations are high, but it's like almost like, are they too high going into this print on next Wednesday, the 19th?
Well, it's one of my favorite jokes that NVIDIA earnings are the new Fed decisions. So, of almost equal import.
How does Jay Powell feel about that?
I haven't told it to him yet.
All right, let's see how our next guest feels about that. Joining us here in studio, too, is Veronica Willis, global investment strategist at Wells Fargo Investment Institute, counting us down to those closing bells. And this has been one of those strange weeks, Veronica, where I think, people are focused on earnings, but they're also focused on the Fed and whatever the heck's going on in Washington with the reopening. And it gets to this idea of the rotation and the repositioning in this market. Are we going to see a meaningful rotation out of some of those big cap tech names into something else, or do people just kind of revert back to what's got us here so far?
I think what we're going to see is maybe a little bit of softness in some of those bigger names, and the smaller names, maybe some other sectors outside of tech, are going to start performing a little better and pull a little bit more of their weight in the index.
Is that going to be based, though, on the corporate fundamentals, meaning people just looking at the revenue growth and the earnings growth in those big names, or is there more of an economic story that also folds into all of this?
I think there's a little bit of a concern around valuations. And so some of those valuations in tech and some of those bigger names in communication services are a little bit stretched. And so investors are looking for a little bit more attractively priced assets to put some money to work.
Yeah, it's interesting. I remember that was one of the narratives around Cisco reporting earlier this week, that even though Cisco is on this amazing run, that compared to maybe some of the other AI names, its valuations don't look quite as expensive. So when you take a look at the landscape holistically here, I mean, where can you find relative bargains at this point, maybe even at a sector level?
Yeah, I think so. Thinking about large cap within the sectors, we like financials, industrials, and utilities. We think that those three sectors are really good ways to play the AI theme without going directly to tech, without going directly to comm services, because those industrials and those utilities are going to be needed for that infrastructure that's going to be behind those data centers for AI, and financials are going to kind of be key for financing those.
Yeah, I was going to ask how financials wrap in, because it's been interesting watching, these different companies sort of go back and forth between the public and private markets when it comes to funding some of these AI hopes and dreams.
That's right. So we see a lot of attractive opportunities in the private space as well to play that AI theme. So in private credit and in private equity, some of those ways where you can kind of play specialized AI themes. But the public markets are going to be really important as well for that financing. So it's one of the reasons that we really like financials right now.
And also with financials, I mean, we were talking earlier this week, obviously, about all the volatility in markets, how that's been a boon, at least for the businesses that have a markets business. But is there sort of a broader sense here, too, that if the financials hold up, in terms of whatever they're doing with regards to AI, the lack of delinquencies, or if you will, to a certain extent on the lending front, and then whatever pickup you're seeing in the capital markets business, can that see the potential for outperformance by financials relative, maybe potentially, to tech going forward?
Yeah, absolutely.
Yeah.
And so I think thinking about the economy, one thing that's really interesting with the government reopening, we think we're going to see that resurgence of economic growth in the first quarter. We're not expecting any kind of recession or anything, and we think the consumer is going to hold up really well, and that's going to bode well for financials when it comes to how consumers are spending. We're not expecting any kind of alarms that are rising on the credit side.
In terms of trying to extend the equity rally, there's been a lot of talk about all of the money on the sidelines, if you will. I mean, you still have money markets sitting either at or near record highs. We had a guest on earlier saying that all the cool kids are in cash, which may or may not be true. But it gets to this idea that there are a lot of people that aren't fully invested in this market by choice.
That's right. And I think part of it is, cash has had very impressive yields. People don't want to give that up with the kind of capital preservation you have built in there in those money market funds. But also the market has really rallied, and it's not left a lot of opportunities to buy in. Yeah. And so we always encourage investors, whenever we get these pullbacks, these moments of volatility, use that as the opportunity to get back invested in the markets, because you don't want to be stuck in cash for a long time.
Well, to that end, I mean, are you surprised that we're not seeing a stronger buying impulse today? You think about the decline we saw yesterday in the S&P 500, 1.6% thereabout. Not an enormous dip, but certainly more than we've seen in a while. And today we're, barely positive on the S&P 500, might even be lower at this moment.
Yeah, I think what we're seeing yesterday and today are still some concerns around Fed policy. It's been a really sharp shift from the market pretty much being certain that there's going to be a cut in December, and now, we're less than 50% odds that the Fed might cut in December, and that's a bit of a shock for the market. The market wants to see cuts. That's kind of what it had built in, and I think we're seeing some repricing of those expectations in the stock market right now.
Well, this is something we were actually talking about in our show meeting today, that it's been interesting seeing the Fed speakers come out this week and really pour cold water on the idea that there's going to be a rate cut next month. And it's interesting that there seems to be that building consensus among the Fed members that maybe they're going to stay put in December, given that it's not like we've gotten any economic data to chew in. So I wonder what you make of that. What has changed since the last Fed decision?
I think what we've heard from the Fed speakers this week is that they are still concerned about inflation. So we haven't seen inflation moving higher, but what we haven't seen is it moving closer to the Fed's 2% target. And they're not, leaving that 2% target behind. They're committed to it. And so I think with inflation at current levels, they're still concerned, and they are wanting to get the market ready in case they decide not to cut, because they're still concerned about the inflation side of their dual mandate.
All right, Veronica, great to have you. Veronica Willis is Global Investment Strategist at Wells Fargo Investment Institute, helping us count you down to the closing bells. That's her. Live television, you gotta love it. Veronica, have a wonderful weekend here as we get you set up here for the final couple minutes of trading, and more importantly, kind of pushing beyond to next week. Katie, there's gonna be a lot going on. Of course, get a lot more earnings, primarily from NVIDIA, a couple of retailers as well, Walmart, Home Depot, Lowe's.
Yeah, absolutely. Yeah. It's going to be an interesting cross-sector read there. And you think about the importance, the urgency around these corporate reports in the fog that we've been talking about that we're living in when it comes to the lack of economic data.
Yeah.
Some of those names you mentioned, Home Depot, Walmart being the largest retailer out there. I mean, these are really important signals on where this consumer actually is and where they're going.
Kind of interesting, too. I mean, you made a good point here. When you had that big sell-off yesterday, you would expect the dip buyers to come in. To a certain extent, we did. We opened lower in the S&P, but we did see a kind of battle back into the green. And now, as we get closer to the bells, Katie, we're basically unchanged on the S&P, down significantly on the Dow by about 0.7%, and the Russell. That's your relative bright spot, only up about 0.1%.
And who would have thought it? The Russell 2000 being the lone bright spot here. Yeah. It'll be interesting to see, what is the next catalyst. I know I was joking about, NVIDIA being as important as a Fed decision, but in terms of what could determine the near-term narrative, NVIDIA earnings on Wednesday, hearing from Jensen Huang himself, that could be it.
All right, as we count you down to the closing bells, full coverage of everything that happened on the day. And of course, I'll put you ahead to what might happen coming next week. Let's bring into the conversation right now Jess Menton and Norah Mulinda, our markets correspondents, here to help us break down some of what we've been seeing here on this day. And I'm going to start with you, Jess, because this was a very strange week in terms of market activity. You had some AI optimism. You had some AI pessimism after, Michael Burry comes out and throws some cold water. Right. You had a government reopening that, based on the columns you wrote, I thought we were supposed to, we're in for the massive rally, but apparently, I guess we have to wait a few more months before we see that.
Well, what's interesting from a technical perspective is, once again, the S&P 500 dipped below that 50-day moving average. And I know people like to joke about those round numbers around 6,700, but it's a real thing, too, because when you're thinking about how actually it's been 138 trading sessions that the S&P's remained above that shorter-term moving average. So that's the second longest streak this century. And so it just kind of shows you from a technical perspective kind of what's going on here. But obviously that's more shorter term. But again, next week, that's going to be big with NVIDIA coming, because that implied move is a little bit above 6% in either direction for that swing after the closing bell next Wednesday. And so that's the highest implied move for that stock in about a year.
Yesterday, we had a massive drop in equity markets that I guess if you're an optimist, well, I guess that opened up the potential for dip buyers to come in and maybe find some bargains. We did see some bottom fishing today, but not enough conviction all around to push the markets materially higher on an aggregate basis. The Dow is going to close lower by about 300 points or 0.7%. The S&P down 3 points, recall it, basically unchanged on the day. The NASDAQ eking out a modest gain of about 0.1%. And Katie, the Russell 2000, that's your relative outperformer, up about 5.5 points or 0.2%.
Yeah, the Russell 2000, those small caps really fighting to stay green. You think about the S&P 500, 182 names finishing in the green, more than 300 in the red. Certainly helps explain why the S&P 500 wasn't able to hold on to those gains.
And we talk about some of the big gainers and decliners out there.
Well, shall we also talk about sectors, perhaps?
Oh, I forgot. This is where you talk to the circle.
This is where I talk
always
to the
forget.
circle.
Okay.
It's like the bright spot of my
Sir,
day.
quiet, everyone.
Please, I'm grabbing the mic here. You can see tech managing to finish in the green right now, but it was energy that sort of ran away with it. Energy, your best performing sector when it comes to percentage, up 1.4%. There's a lot of red to talk about, though. Materials having a terrible day. So, too, were the financials, communication services, healthcare. The list goes on. Certainly more losers than winners here, Jess Menton.
Yeah, and especially when you're thinking about also with DoorDash. That's one of my first stocks I wanted to point out for today. So it's actually up 6%. Best day since April 9th there. So
wait, that's the biggest gainer in the S&P today?
Right, if you look at that dash. Surprising when you look at these. Also ahead of the NASDAQ 100, too. So actually, its shares gained, if you're looking at that. So Needham was defending the stock after that earnings-induced decline that we saw earlier this week. So they're still saying that their price target lowered to $275 from $300, but they're still maintaining that buy rating, too, after the big sell that we had there. And then, of course, if you want to look at another one, Micron Technology, that's the second biggest gainer today in the S&P 500. So MU is the ticker symbol on that. It's actually up 4%. That is its best day since not too long ago, November 10th, so earlier this week. But actually, Reuters had put out a report. So you're seeing some of those companies move relative to what they're doing in the chip type space. So SanDisk was another one in addition to that moving higher. So Reuters reporting that Samsung has hiked rates on its memory chips up to 60% since September. So looking at that, kind of giving a boost there to some of those different names there. And then lastly, I wanted to point out what's happening with Warner Brothers. So looking at those shares too that are higher, up also about 4% today. So they actually amended their CEO contract to protect pay in a sale. So that's why you're seeing that supported. And of course, I know Romain always asks me about the weekly.
Yeah, I was about to give you your pop.
Of course, I thought you were going to do kind of a pop quiz here.
I was.
So Albemarle. That's looking. So actually, this is a company that produces specialty chemicals and additives to those types of medicines. So you're seeing analysts raising those targets with lithium prices, but up double digits. So that's more in a different type of space, not necessarily the tech space there, but that's above the leaderboard here for a weekly basis.
There you go.
All right, a lot moving to the downside, of course, today. Norah, you had a lot to pick from.
A lot to pick from, a lot to sift through, really. I was looking at shares of StubHub, the stock really in focus here. We did see the stock fall about 21% at the closing bell. And this is really after the company failed to provide a fourth quarter forecast. That forecast disappointed, but they also didn't provide a forecast for the current quarter. This is a company that just IPO'd just back in September.
Yeah.
So you are really seeing Wall Street grappling with, what is the outlook looking like moving forward, especially for a company that just recently debuted? So you are really seeing that weighing on shares in the trade today as it ended on this Friday. And we should point
out, I mean, look at that price, $15. This debuted at 34.
Right.
So it's lost half its value in what, 2 months time? Roughly?
Something like that.
Just a couple weeks, it feels like.
Yeah.
Also looking at shares of Walmart, this is a stock, of course, that we've been talking about all day throughout the trade. It just ended just a touch lower, down about 0.1%, just eking out a decline there. there. So we did see the CEO change. Of course, this has really been in focus for this company. We do know that McMillan, he retired. He'd been CEO since 2014, and we do have John Furner coming in as the replacement. While you did see a little bit of uncertainty, specifically in the market and how investors were thinking about this company, you do have a lot of traders, a lot of analysts on Wall Street that are saying that this actually shouldn't be that much of a negative here. Maybe near term, you may see some weakness for the stock, but long term, this should be a positive, a good transfer of power here. So you definitely are seeing this company in focus. Shares up about 13% on the year. And lastly, I'm looking at Aero Group. This is the company that actually isn't doing too well. This is an aftermarket supplier for a lot of the aerospace companies. I used to cover aerospace on the equities team, so had to point out one of those. We did see this one dropping
below. Were they
below.
involved in all the flight delays that I got stuck in?
Hopefully not, right? There were too many to count, honestly. But we did see Aero Group dropping below its IPO price for the first time. This is after its third quarter revenue missed expectations. We saw shares of Aero Group down about 21% to end the trading day today.
All right. Nice roundup here, too. And we talk about, of course, what has been a wild week, and that could change in a big way next week. Of course, keep an eye on yields, because as we start to get more economic data, that might put the yields into a little bit more perspective into the direction that they might go. They are higher on the day, but it was a mixed bag on a weekly basis, all heading into a big Fed meeting just about 3.5 weeks from today. A lot of Fed members speaking right now. Basically, no real consensus out there. And Raphael Bostic, the outgoing member of the Fed, Atlanta Fed, now speaking, saying that basically the data is moving in opposite directions of both of their mandates.
Yeah, it's really interesting to see that mandate basically come into conflict. It's going to be a very fun Fed decision in December, at least for those who follow those sorts of things. Anyway, great roundup, you guys. Closing the markets on this Friday. That is Bloomberg's Jess Menton and Norah Mulinda helping us break it all down. And speaking of breaking, let's turn to some breaking news out of Alphabet right now, investing $40 billion in new data centers down in Texas. Let's head there now and bring in Bloomberg's Julie Fine. So, Julie, give us the details here. What exactly do we know about this planned spend so far?
So we know that they will be spending, again, $40 billion in Texas. That will be for 3 data centers. They will be in the Panhandle. One, I believe, will be in the Panhandle. 2 will be in West Texas. That is near Abilene. By the way, this is an addition to what Alphabet Google already has here in Texas. They already have a $2.7 billion investment around Dallas. They have 2 data centers in the surrounding suburbs. So a big announcement for Texas. The governor is with the CEO of Alphabet Google right now making this announcement.
Are they building power to go along with these data centers, Julie?
What one of them they are going to have is one of the Haskell facilities actually will be co-located with a new solar and battery energy storage plant designed to ease the data center's impact on the power grid. As you know, and we have discussed this, Texas power grid has been a problem in the past, although for the past couple of years we have not had any issues during storms. So that definitely is part of one of those data centers.
And Alphabet is just one of several of these AI-focused companies investing in Texas. Talk to us about what exactly is going on in the state, who they're competing with here.
Well, there's also, we have to talk about the first data center being built. That's the Stargate venture. That's backed by ChatGPT AI, Oracle, and SoftBank Group Corp. That's also in Abilene, Texas. That is a big deal there. Meta Platforms is also building a new gigawatt-sized data center in Texas. So Texas is getting an abundance of these here in the state, which is very interesting because, as you know, the power grid has been in the forefront in many cases here. The Texas legislature, however, did put some guardrails in place during their past session and clearly signaled they are open for business when it comes to data centers.
All right, Julie Fine down there in Dallas, Texas. The headlines crossing the wire right now. Alphabet's Google planning to invest $40 billion in 3 new Texas data centers through 2027. A lot more coming up here on The Close, including some big moves in the ETF world. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. And an interesting end to what has been a relatively volatile week. The VIX elevated here on this Friday afternoon after spiking yesterday. That big downdraft that we saw in stocks on Thursday. A lot of concerns right now about tech valuations, a lot of concerns about the state of the economy. Nevertheless, despite some of the pullback that we saw yesterday, the dip buyers did come back in today and did try to put a floor under that market. The S&P finished the day unchanged, but finished the week in the green. The Russell 2000 also in the green as well. Indicative here that there is some optimism out there for some asset classes. We'll just have to exclude Bitcoin from that conversation right now, Katie Greifeld, as it still sits perched below 95 grand.
It'll be interesting to see how low it can go, but let's get to some of the single name movers on this Friday. I wanted to talk about DoorDash. Of course, it had a pretty ugly earnings reception, though, but Needham coming out defending the stock, sending shares up about 6%. Also highlighting Warner Brothers Discovery. We know that the sharks are circling this company, a bidding deadline coming up next week. Shares up about 4%. And then MicroStrategy, related to what Romaine was just telling us about what's going on with Bitcoin. MicroStrategy, of course, sort of a leveraged way to get exposure there, down about 4% on the day. Our top story this hour, though, is that 2025 is shaping up to be another record-setting year for actively managed ETFs. But there's an important asterisk. If we take a closer look at the fund flows, it looks less like a grand upswell of demand for active managers and more like a migration from mutual funds to ETFs. Let's take a look at the chart right here. And you can see that in white, you have your active ETFs. And the past 2 years actually have been records for active ETF inflows. Then you take a look at active mutual fund outflows. Those are your orange or yellow bars. And you can see that it's not exactly a perfect offset, that we've been seeing a lot of money exit active mutual funds. So let's bring in Jack Shannon. He is principal of equity strategies over at Morningstar. And Jack, I think this is a really important conversation because if you took a look just at what's going on in the ETF industry, you could say, okay, we're seeing a lot of demand for active management. Totally different story if you include those mutual fund outflows in the conversation as well.
Absolutely. It depends on what you call active, right? So if you group active as anything that deviates from any sort of market weighting, there's lots of things that get thrown into active. So you have like these systematic investors like Dimensional Fund Advisors, Avantis Investors. They've been very successful in the ETF space, but I wouldn't really consider them truly active. And then you have also these income-oriented option income ETFs that are getting a lot of inflows. I also wouldn't necessarily call that, really true active management in the sense of like picking a stock portfolio to beat the index. And if you look at just those, like the true stock picking mutual funds and the ETFs, it's a big, big difference in terms of flows. You have a lot of outflows in the mutual funds and relatively few going into these newly launched ETFs.
Yeah, and you can include the leveraged single stock ETFs in that grouping as well, because they do technically count as actively managed here, Jack. So when you think about, though, just the traditional view of active management, you have in bottoms up fundamental active manager picking stocks, picking bonds. It seems like that has totally fallen out of favor. And I wonder if we ever see that demand come back.
The performance has to come back. Before the flows come the performance, right? And investors are notorious for chasing good performance and for fleeing bad performance. So if active management wants to make a comeback, they need to perform better. Quite simply, part of that could be lowering their fees, and so that might be one angle that the ETFs have a positive impact, is that they're generally priced at like the lowest end of the mutual funds out there. So maybe you'll get a little bit of better performance through that. But overall, until they improve their performance, you're going to keep seeing outflows.
Talk to me, Jack, a little bit about the ETF share class transition and the idea of how that either helps this situation or exacerbates it.
It's a little early days to see how it'll truly impact things. So a lot of asset managers got in line to put their hands up and say, hey, we want to do this. I think there's a whole lot of operational sort of back-end infrastructure items that need to get resolved. There's still some sort of unopened tax questions, like if the mutual fund has a bunch of unrealized gains and they realize them, does a new ETF share class have to eat those gains? And so basically, are you going to lose the tax efficiency in the ETF when you do that? So I think asset managers that we've been talking to are being very deliberate about how they're sort of rolling that out in terms of the share class. I think we will see it become quite popular. I just think it'll take a little time as some of the infrastructure build gets done.
But I'm curious, when you look at kind of the maturity of this of the ETF industry, and I am just curious as to where the innovation is, if at all. And this isn't a knock on Katie, because I know she covers this all the time. She loves this stuff. She talks about it every day. But sometimes I have trouble seeing like what's really new out there. It just seems like it's just different iterations of the same thing.
Well, there's a lot, there's a lot that they're trying to do, right? You have these, public-private ETFs that are coming to market where they're trying to combine some very illiquid assets into the ETF wrapper. We at Morningstar are not super fond of those strategies. We think there's some serious liquidity issues that may come. But you are seeing some innovation there, right? You're seeing, this democratization of private assets is certainly coming to the top of the funnel via the ETF structure. So. And then you have all the leverage stuff that Katie mentioned, right? Mm-hmm. You have all these, yield-generating ETFs that people love, right? People love yield.
I was going to say, Romaine, does the idea of a 5 times leveraged single stock ETF not excite you?
It scares me, Katie Greifeld.
That honestly is probably a pretty good response. Jack, before we let you go, let's talk a little bit about the pace of launches here. Because you think about active ETFs, they're ballooning in assets. They're also ballooning in just the sheer number of funds here. When do we see that pendulum sort of swing back around and potentially lead to fund closures?
I think we will see that, maybe in a year or two. So a lot of these firms are going to be deliberately patient with these, right? They might be more patient with an ETF than they would with a new mutual fund just because, it is, in their eyes, a growth area. But if you look at most asset managers say, if I don't have $100 million in this fund, in this ETF, it's not profitable, I'll probably close it. If you use that as the barometer, about half of the ETFs are below that sort of break-even point. And so, again, I think they'll be a little patient with these, maybe more so than they would with mutual funds, but certainly a very large percentage of these will probably not be around in 2 or 3 years.
All right, Jack, great to get some time with you. Happy Friday. That is Jack Shannon. He is Principal of Equity Strategies over at Morningstar. And for more ETF insights, be sure to check out my ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. This week's edition actually features part of our conversation with the CEO of SIBO and basically what their plans, their future plans for their ETF business are.
That was a great conversation, Katie Greifeld.
I enjoyed it.
We also had a great conversation a little bit earlier about what's going on in the AI space. We were just talking with Julie Fine, of course, about that big data center project down in Texas. But did you know Illinois? It's actually like the 3rd largest data center market. And the guy on your screen, Gil Quiniones, he runs the utility that's in charge of trying to keep up with all of that power demand. Some clips from that conversation when we come back after the break. This is The Close on Bloomberg. All right, data centers account for about 3 to 4% of U.S. electricity demand, but that is actually expected to quadruple over the next few years. Utility provider ComEd seeing part of that boom and trying to figure out how exactly various industries will harness that power grid and how to adapt. One way it's doing is what you're looking there at your screen. That is actually the former Chicago Board of Trade building. It's now being converted into a power center. We had a chance to check in with the CEO of ComEd, which oversees the utility that are in the Chicago area, Gil Quiniones, to talk a little bit about how his company is evolving in this new era. Take a listen.
Well, we are working diligently to meet that load growth. For the last 10, 15 years, our load has been flat, and we're now seeing our load growing between 2 and 4% over the next 5 to 10 years. And so we are building our infrastructure as quickly as possible to meet that growth.
With regards to building out that infrastructure, I mean, you've recently taken on a big project right in the middle of downtown Chicago, a place where you wouldn't necessarily think you would have a major electricity substation. But you chose that spot for a reason. And I'm curious as to why you would locate something of that size there and what type of demand that you've already seen for the future power generation coming out of it.
Well, it was really fortunate that we were able to acquire the former Board of Trade building. It's so appropriate for many, many reasons. Load is growing in our central business district, and we need to bring power into that area to meet that load growth. And we should be able to create a little bit over 200 megawatts of extra capacity once we build that substation between 2027 and 2030.
When it comes to this surge that we're seeing in power demand, specifically from AI, one of the hot button issues here is whether or not consumers are actually footing the bill, whether they're paying for that. And from where you're sitting, I wonder what your perspective is.
Yeah, well, here in Illinois, we actually have a tariff modification that we submitted to our regulators to make sure that costs are not shifted to our other customers should those data centers do not materialize or their load are not going to be what they expected them to be. So we are laser focused on make sure that we not shift the cost, and also we protect our customers from stranded investment risk.
Well, with regards to the increased costs, I mean, how are you mitigating that? Because we've seen in other jurisdictions outside of Commonwealth, Edison's reign, have to deal with this issue of wholesale prices going up and having to pass some of that on to the individual consumer. Are you thinking about potentially raising the prices that you would charge some of your industrial and technology customers as a way to blunt the impact on your residential and small business customers?
No, you know, we belong to the PJM grid operator, which is the 13 mid-Atlantic states, and they're actually the ones that determine the supply cost for our customers. So that portion of the bill, the supply cost, is really just a complete pass-through, and we do have an imbalance right now of supply and demand, and that's what's causing the upward pressure on rates. And so we are advocating for the right market reforms. Unfortunately, PJM is not working as expected, and their reforms are not coming as fast as they should. But you know, we want to make sure that if the markets do not work, that we are also ready to step in, and that's what we're telling our regulators in terms of increasing supply right here in Illinois.
But how much discussion have you had about the structure of those PJM auctions? And I understand on a legacy basis they made sense, but when you're talking about future power needs, which is essentially what these auctions are auctioning off, and you don't necessarily know exactly what those needs are, you get distortions in price, you get distortions in what's available. Have you had meaningful discussions either with PJM, federal regulators, or local regulators about maybe addressing that auction process?
All of the above. We always advocate for our customers, make sure that our supply costs are affordable here in Illinois, and also our sister utilities on the East Coast, as part of the Exelon family. And but at the same time, what we are now saying is that if those reforms are not enough, if the private sector is not entering, we would like to have the opportunity to step in and provide that solution of additional generation, because then states can have more control over cost and over the certainty of managing affordability for all of our customers.
You're asking for the developers to actually put down deposits. We were talking a little bit about phantom data centers and the idea that some of them aren't even getting built. And I was hoping you could just walk us through that logic a little bit more, requiring deposits.
Yeah, what we're basically saying is before we upgrade our grid to accommodate and interconnect these very large loads like AI data centers, we will project our revenues over the next 10 years and basically ask them to post either a letter of credit or cash or a combination of both to make sure that if those revenues do not materialize over the next 10 years, that we can protect all of our other customers.
That was ComEd CEO Gil Quiniones, and we should note that Gil ran the New York Power Authority during the mayoral term of our founder and majority owner, Mike Bloomberg.
Some quick breaking news down coming out of Washington. This on the price of food. The Trump administration says it's actually going to cut tariffs on beef, coffee, tomatoes, bananas, basically things that can't be grown at scale here in the United States. Remember, he imposed those tariffs earlier this year, which sent prices on a lot of those goods higher. Today, we're learning he's exempting hundreds of those products from tariffs. This is The Close.
What physical places give us are the ability to support the things around work that actually make work better. And that's what I think a lot of executives are missing, is they're putting the burden on the employee via mandates instead of shouldering the burden of creating spaces and places that actually add value to people's lives and that actually accelerate the outcomes that they're trying to see in the marketplace.
And that is Phil Gilbert, a legend over at IBM, who led basically their design team and really talking about the way he thinks about design, more than just the physical, as a lot of people talk about the return to office, but more so about the culture, design of that culture. Our next guest spent almost a decade at the helm of Jamba Juice, spearheading a total turnaround at that company. And he's out with a new book about his management style called Culture Design: How to Build a High-Performing, Resilient Organization with Purpose. Pleased to say joining us right now is James D. White, right here in Studio 2. Great to see you.
Good to see you. Thanks for having me.
I want to start off with this idea of what design really is, because we were speaking with Phil Gilbert earlier this week, and he really kind of hit home this idea that it really isn't always about the aesthetic. It is about trying to create a culture within a company, particularly when you're trying to turn around a company and motivate the employees to go along with whatever that top line vision is.
So the way we think about culture, you have companies have culture by design or default. That's kind of the thesis of the book. All companies have culture. You might as well build the one that you want.
How hard is it to come into an organization where you know that there needs a lot of change, and going to your hundreds, or in this case thousands of employees, and trying to sort of articulate not only what you want from them, but having the confidence that they're going to follow?
We have a very disciplined process that we talk about in the book: knowing what matters, doing what matters, and then measuring what matters. So if I just think about my own Jamba experience, as I came in kind of the first week, what I wanted to do is really spend time with the stakeholders. And the first place we started was in the support center. And I had just 4 basic questions. What are the things that I should stop doing in the organization? What are the things we should start doing, and what things should be continued? And then the final bonus question is, what advice do you have for me as CEO? So listening is the first place we start. And then for me, what I think of as an archaeological dig, where you're literally looking at all the things that we say we stand for, documenting those, and then laying out a future vision for what the ambition is, and then what's the gap between what we say and what we do, and then kind of marching forward from there.
And how do you balance building trust with making hard decisions that I have to imagine that a chief executive has to make when they come into a company, when they come into a role where they're expected to execute a turnaround? Because I have to imagine for a lot of CEOs coming into that sort of role, it involves laying people off. It involves cutting out new businesses. It involves, bringing in new ones. And I have to imagine it's difficult to thread that needle with also building trust with your employees.
Well, the main way you build trust is by, really good communication, good listening skills. We talk about listening with heart. And one of the core capabilities that we believe leaders are going to need to have more of is empathy. So if I look at what's happening in the world today, this acceleration of AI, one of the things that we're missing is we're leaving the people out of that entire conversation.
Sorry, but not to be pedantic, but haven't we kind of left empathy behind? I mean, I feel like corporate America kind of went through that empathetic phase, and then at some point they decided it just wasn't worth doing it anymore.
What I would say is the best leaders absolutely haven't done that. The leaders that we interviewed for this book and talked about, they actually lead with the humans first, people first. And I'll give maybe 2 examples. So I'm just flying in from Wisconsin. Actually, the last chapter of the book, we talk about a regional supermarket, Snook Supermarkets, my hometown, 86-year-old company, literally 4 generations of leadership in that company, and we just made the biggest acquisition in the history of this company, festival in Wisconsin. So one of the ways that CEO, Todd Snook, prioritizes really building empathy and understanding culture is he flew the entire board. We went to Wisconsin, and the deal just closed 3 weeks ago, to meet all the employees, to walk the stores and really get to feel the culture. The one surprising thing on that visit for me, and it's appropriate for this discussion, festival actually brings culture to life. And I'll give an example. They have a daily huddle at 9:35, 9:40, every one of their 40 stores, where they huddle up and it's just 10 minutes where they set the direction. And that's the best illustrative example I can give you of leaders that really bring culture to life as an example.
Well, it's a really interesting illustration because you think about big acquisitions, you're not just integrating products or different services into an existing company, you're also integrating a whole other workforce and trying to make those two cultures fit together. And you think about these big combinations, sometimes, you know, it's not smooth sailing exactly.
Yeah, you start with the people. The other example I give you is a lifestyle fitness company, Bay Club, on the West Coast. They're literally acquiring another lifestyle fitness company a month over the last 15 months. So they're constantly adding new employees and trying to integrate culture. And the couple points that I'd make here, their CEO, Matthew Stevens, really started as a frontline worker in this industry 40 years ago. So that's where he starts as he's building culture. One of the resets they did kind of post-COVID is they hadn't touched their culture and vision in about a dozen years. So they came back and really did a huge refresh, and it really has unlocked the full potential of this company. On an annual basis, they have an event that they describe as Polaris, where they literally do a renewal around strategy and culture to keep driving the company forward. But those are two examples.
All right, James, got to leave it there. Really enjoyed this conversation. That is James D. White. He is the former CEO of Jamba Juice and the author of Culture Design, How to Build a High-Performing, Resilient Organization with Purpose, co-authored with his daughter, Krista White. Now, let's switch gears here because we're also going to be talking about how it takes a lot to bring a consumer product brand to a multi-billion-dollar valuation. But our next guest has done just that. It's a 10 Haircare is one of the few beauty brands without any outside backers, boasting roughly $500 million in gross annual sales, despite what some have characterized as a more selective consumer. The company just rolled out its first ever U.S. college campus activation, providing over 400,000 students with free samples of its products. Joining us live in studio, I'm pleased to say we have It's a 10 Haircare founder and CEO, Carolyn Aronson. Carolyn, great to see you in person.
Pleasure. Thank you for having me.
So let's talk about the consumer and what It's a 10 Haircare is sort of bringing here, because some have characterized it as a more selective consumer. Others have characterized it as a consumer that just doesn't want to pay up in the same way that they have been for the past several years. So talk to us about how you're navigating some of those different cross currents.
I think there's a lot of different ways that we're navigating it. We're connecting with them in different ways, but we're also really speaking to the consumer in a way that's very direct through that navigation, through social media, through hands-on activation, pop-ups, things like that. And what we're really, our message is that we understand what you're going through. We understand that expensive hair care isn't for anyone anymore. And so for instance, we made an announcement that due to tariffs, we're not raising our prices. So we are a very nimble, self-owned, indie-owned brand that really kind of goes where they don't go. We connect in really different ways with the consumer. We're about to turn 20 years old. So we're also connecting with our college tour with a younger consumer. But we're also speaking to the pains of our society. We understand. At the same time, they're also demanding more, better quality ingredients and different types of products. So it's really about being able to move, pivot, and be nimble as an indie-owned company.
Well, let's talk a little bit more about the college tour, the push here to get your product in the hands of younger consumers, because I always am curious, when you see these sort of sample giveaways, those types of campaigns, what does the ROI on that look like if folks actually have a chance to try out your products without committing to buying?
Can I tell you, it's incredibly high. This company was built on our Miracle Leave-In product. We now have 11 different variants of that product with collections built around each one. We sell 11 million bottles of that product just in the United States, and we're now in over 130 countries worldwide. I started this company with $80,000.
Wow.
We didn't have big marketing budgets, and we built it by giving out free samples of our Miracle Leave-In product. So it's really, to me, it's the entryway. And it's interesting. I was just at the University of Miami this weekend. My daughter goes there. I was at the pop-up handing out product, and I can't believe how many young people came up and like, oh my God, I know this product. Give me one, give me one.
Yeah.
So although we're 20 years old, we might have been their mother's hair care, we are still loved and embraced by the younger generation.
You know, I'm fascinated, Carolyn, by the idea that you haven't taken on major outside investors. You basically stayed indie, as you say here. But as you continue to grow and get bigger, do you see maybe the need at some point to bring in outside investors?
I don't, thank God.
Yeah.
And I'm kind of old school when it comes to all of that.
Yeah.
I know there's a lot of brands that bring in venture or maybe sell a portion of it.
Mm-hmm.
We actually have created It's a 10 Enterprises, which now has 5 other additional brands underneath it. Be a 10 Makeup, Rewind at 10 Men's Beard and Hair Color. We created Cloud, a retail brand. So we're actually expanding. More beauty needs are being met by our brands. And so we're actually building more.
Do you find that that's necessary, particularly in the consumer product space, to maybe do that? I mean, I know there's been a lot of talk about how even a lot of CPG products can't even really attract venture capital the way, say, I don't know, an AI or something that's hot in the zeitgeist. Is that so for, you know, the next sort of entrepreneur out there who's watching this? Is he or she, is that kind of the path forward for a CPG brand?
I think so. You know, if you can't, listen, I'm a strong believer in starting small, especially when you have social media like TikTok. I've seen some brands blow up overnight. And really funding yourself, starting off with that hot one product like I did, that Miracle Leave-In product, and letting it kind of build and grow on itself. There's nothing wrong with that. Everything doesn't have to be instant and having, you know, the big investors coming in, spending the big bucks. There's a lot of ways to success in today's society. So, you know, I believe in doing it that way as well.
All right, so what's next?
What's next? 2026, as I mentioned, we're 20 years old. My book is coming out, and we're expanding. We continue to expand as far as additional brands, but we have a lot to celebrate next year, and we are going to be rebranding as well. So we have a lot of really excited things to announce through 2026.
Intriguing. And I forgot about Rewind. We had Fat Joe on a couple times talking about it.
That's right.
Carolyn, great to have you.
Thank you.
It's been a long time
Thank you for
coming. Just a fascinating story here, from being a hairdresser to building a company with hundreds of millions of dollars in sale. It's a 10 Haircare. All right, Katie.
Yeah, let's take a look at how these markets closed. It is Friday.
It is Friday.
Trading
Can we go?
is over. No, not yet. Not until I tell you how we performed on the day. You're taking a look at the S&P 500.
That's a scintillating board I'm looking at.
Didn't exactly manage to finish in the green. Barely down, but still the color is red. The Russell 2000, as you mentioned, Romaine, that was your outperformer on the day, but just barely. You take a look at the VIX. Below 20, but just so. And then Bitcoin continuing to fall, now below $95,000 a coin. This is the close on Bloomberg.
College sports taking center stage with football selection Sunday less than a month away. Basketball season tipping off earlier this month. This is universities under a lot of pressure right now to find new ways to raise revenue after the landmark settlement over student athletes' name, image, and likenesses. A recent survey of Division I leaders shows 75% say the settlement terms will have a negative impact. Joining us right now to talk about this is one of the people helping conduct that survey. Amy Privette Perko is CEO of the Knight Commission on Intercollegiate Athletics, a college sports reform group that prioritizes the education, health, and safety of our college athletes. Amy, great to have you here. When we found out you were coming on, we were kind of having this discussion and just talking about everything that's changed with college sports, particularly college football, primarily because of, I think, what for years had been just an understanding that there wasn't sort of an equitable share of the revenue that college sports was generating. But since we've had these lawsuits and decisions, it's kind of upended the whole apple cart. And I feel like we have not reached some sort of equilibrium as to what this is all supposed to look like. Do you think we're going to see that equilibrium anytime soon?
Anytime soon is a key question. We are in a major moment of disruption, historic changes in college sports. For the first time ever this year, universities were allowed to provide athletes with direct NIL compensation. And so universities, Division I, are going through major changes, trying to, balance these new financial costs. Certainly athletes benefiting in new ways. But as the survey showed, there's a lot of concerns about what the results could be for Division I as a whole. I think on an individual basis, certain individual athletes certainly will benefit greatly. But there's concerns, and we want to make sure that regulations are put in place so that there can be more stability, so that we can continue to provide these just incredible experiences that college sports provide to young people.
But how do you sort of rein that in? Because it's not just the name, image, and likeness. Obviously, the transfer portal is just on fire. I mean, the buyouts that we've seen in some of these college football coaches, I think the latest stat I saw were basically at unprecedented record highs in terms of the payouts that we're having there. I mean, for something that's not necessarily supposed to be big business, it sounds a lot like big business.
Yeah, absolutely. Let's take a couple of those points you just made with the transfer regulations. Right now, college athletes can transfer an unlimited number of times and be immediately eligible. And the survey we conducted with Elon University poll showed that presidents, athletic directors, the campus leaders, more than 80% of them favor some change to the transfer rules to still allow some freedoms for the athletes, but for there to be some greater regulation to it. Ultimately, we want to make sure that athletes continue to graduate, and we know that retention and staying in school and making progress toward a degree is the best predictor of graduation. Some of the federal legislation being proposed. There's two different proposed bills right now, one in Congress in the House that's called the SCORE Act, and it does put some potential regulations in on transfers, as well as the SAFE Act that Senator Cantwell introduced in the Senate. So over the next couple months, we'll see lawmakers debating unprecedented federal legislation for college sports. And on the buyout, college football buyouts, we just hit a new record. There were 11 football coaches fired just earlier this season, and the severance obligations are $184 million just for 11 football coaches. When the college football playoffs started just 10 seasons ago, the severance pay was $30 million for the head and assistant football coaches. So we've seen just, and I see you're showing the graphic there, just tremendous growth, obviously, with the severance pay. It's really exploded. And to us, it's a clear symptom of a broken financial model in big revenue football. In nearly every state in the U.S., the most highly paid public official is the head football coach at one of the state universities. And now in a few states, unfortunately, the most highly paid public official will be the fired football coach being paid not to coach. So, I bring up that example to say, while Congress is looking at unprecedented legislation that could put in some new regulations around the athlete compensation and some more regulations, it may be time for Congress to look at the conditions that allow the continued growth of these excessive compensation and severance packages for football coaches.
All right, Amy, unfortunately, we have to leave it there. Great to get some time with you on this Friday. That is Amy Privette Perko, CEO of the Knight Commission on Intercollegiate Athletics. Meanwhile, we do have some breaking news crossing the wire. This coming from an FAA notice. The U.S. dropping flight reductions to 3% from 6% starting November 15th. Tomorrow, that is starting, and that starts at 6 a.m., Romaine Bostic.
Oh, okay, well, let's hope it helps me out this weekend as opposed to last weekend. We'll be back in a moment. This is The Close on Bloomberg.
Some of Wall Street's biggest names offering a public snapshot of their portfolios as we approach the deadline to file 13Fs. Joining us now is Hema Parmar, who covers hedge funds for Bloomberg News. So you've had a chance to go through the different filings here. What's hot, what's not?
Yes, so as we look at the aggregate data across the thousands of funds that have reported, we are still missing a lot of big names. Hedge funds do tend to procrastinate to the last minute, but from what we've seen so far, some of the popular buys, Apple, Nvidia, and Alphabet. Okay. And then on the flip side, some of the most common sells, Netflix, Philip Morris, and Intuitive Surgical. So some of these you'll see the stock has gone down on the common sells. If you take a look at the chart right here, and this looks like the most popular buys. So NVIDIA, Apple.
Well, as far as the buys, I guess that makes sense. Apple, certainly NVIDIA, and I guess Alphabet to an extent. With some of the more tech-focused hedge funds, like I guess like Tiger Global and a couple others, give me a sense here of kind of like, are they also chasing the same big tech names?
So kind of. You know, we did see a little bit of a buying of Netflix from Tiger Global. But the most interesting thing with them is a big sell. So they sold 63% of their stake in Meta. Now, we don't typically see big moves of every now and then it does happen. Oftentimes we see buying and selling on the margins of the tech stocks. This is what they play in. But this was a sizable slashing of their position. It was its biggest holding. It's now its 6th biggest holding. Still worth over $2 billion. You'll see how the stock performed. It looks like they might have gotten out. It's down about 17% in the third quarter, so it might have saved them from some of that risk. It is a bit of a volatile stock, as you've seen.
Fascinating. Meta has been a really interesting story this year. We only have 30 seconds. Tell us quickly about the family offices, what we're seeing there.
Yeah, so a bit of a split opinion on Oracle. Some of the family offices bought, some of them sold. David Tepper ditched it entirely. People do care a lot about what he thinks with his Appaloosa.
We do,
Yes, he also boosted his stake in Whirlpool and ditched Intel.
Whirlpool? Yeah. All right, I have to check that. This is why I love the 13F filing, so you kind of get a sneak peek into what these people really think about. Backwards looking, but it's definitely helpful. Hema Parmar, who covers this for us here at Bloomberg, as we wrap up our coverage here on The Close. Katie Greifeld, a wild week here. I think we should go out, get some drinks, and get some nose piercings.
Maybe get a tattoo or two. Anything could happen.
Sure thing. All right, thanks for joining us here on The Close. We'll have all your market-moving coverage next week. A busy week up ahead with the release of economic data, more Fed speak, and more earnings, including out of Netflix. Out of NVIDIA, excuse me. Sorry.
The other
This is
end.
The Close on Bloomberg.